Did you know some of the richest people in the world pay little to no taxes legally? Meanwhile, average earners like you and me are stuck with a 20 to 30% tax bill. How's that fair? Well, it's not about fairness. It's about strategy and knowing the system. Today, I'm breaking down exactly how the rich legally avoid taxes and how you can use these strategies to keep more of your hard-earned money. Most of the rich people don't rely on salary. They know that earned income, which comes from salary or wages, is heavily taxed. Instead, they use investments, real estate, and businesses to pay way less in taxes. And here's the kicker. These are taxed at a much lower rate than a regular paycheck. Capital gains are taxed at just 0 to 20%, compared to salaries, which can be taxed up to 37%. That's why the rich people avoid earning taxable income the way most people do. They use businesses and write off expenses. The rich don't just earn money, they control how they are taxed. Owning a business unlocks powerful tax benefits that the regular employees don't get. Imagine you're an entrepreneur, your car, phone bill, even part of your rent could all be tax write-offs as long as they are tied to your business. The rich people never sell their wealth, they borrow against it. Why? Because loans are not taxable. If they need $1 million, they don't sell their stocks because that triggers taxes. Instead, they take a loan using their assets as collateral, completely tax-free. They use real estate loopholes. Real estate is a powerful tool for reducing taxable income. When you own real estate, you can depreciate the property over time. Depreciation allows investors to write off a portion of the property's value each year, reducing the taxable income from rental properties. Even though the property might appreciate, depreciation deductions can offset rental income, resulting in no taxes owed. Rich investors may have properties that are generating income, but they report a loss due to depreciation. This reduces their taxable income on paper. Wealthy individuals use a strategy called the 1031 exchange to avoid paying capital gains taxes when they sell their property. This allows them to reinvest profits into a new property without paying taxes on the sale. It's a deferred tax strategy, meaning they can keep their wealth growing while deferring taxes indefinitely, as long as they continue reinvesting. They pass down wealth without heavy taxes. When wealthy individuals pass away, their estates can be taxed at high rates, but instead of letting the government take a big chunk, they plan ahead using strategic tools to minimize or even eliminate estate taxes. By placing their assets in an irrevocable trust, they remove those assets from their taxable estate, ensuring that their successors receive more while reducing estate tax liability. Many wealthy individuals use life insurance policies designed to pay estate taxes or transfer wealth tax-free to their beneficiaries. These policies provide a tax-free payout, ensuring that successors receive their inheritance without a major tax hit. Instead of waiting until death, the rich gradually transfer their wealth through gifts, taking advantage of the annual gift tax exclusions. In 2025, they can gift up to $18,000 per person per year without triggering taxes. Over time, this allows them to pass down significant wealth tax-free. By using these methods, the wealthy ensure their money stays in the family rather than going to the IRS. Now that we have learned how the rich avoid taxes, let's talk about how you can take advantage of these same strategies no matter your income level. When it comes to keeping more of your hard-earned money, one of the most powerful tools available are tax-advantaged accounts. These accounts allow you to either grow your money tax-free or deduct your contributions that can save you thousands over your lifetime. Let's break down 3 of the most popular ones. A Roth IRA is a retirement account where your investments grow tax-free, meaning you won't owe any taxes when you withdraw your money in retirement. When you contribute to a Roth IRA, you are using after-tax money, so you don't get a tax deduction now. But the real magic happens later, because when you retire, you can withdraw both your contributions and earnings completely tax-free. Here's a little known secret. You can withdraw your Roth IRA contributions anytime, but you cannot touch your earnings unless you're at least 59.5 years old and you've had the account for at least 5 years. So you will need a little patience to fully enjoy this benefit. Also, there is a limit on how much you can contribute each year. For 2025, the limit is $7,000, but this can change every year. Health savings account is one of the most powerful tax-free accounts because it gives you a triple tax advantage. Your contributions are tax deductible, your money grows tax-free, and withdrawals are tax-free as well when used for qualified medical expenses. To open health savings account, you must have a high deductible health plan. The best part? There is no expiration date on your money. You can save and invest it for years, even into retirement. However, if you withdraw money for non-medical expenses before age 65, you will pay taxes plus a 20% penalty. After 65, you can use it for anything without the penalty, although you'll still owe income taxes if it's not for healthcare. For 2025, the contribution limit is $4,150 for individuals and $8,300 for families. And if you are 55 or older, you can contribute an extra $1,000. A 529 plan is a tax-free way to save and invest for education. Your money grows tax-free, and withdrawals are tax-free as long as they are used for qualified education expenses like tuition, books, or even K-12 private school fees. There is no annual contribution limit, but each state sets a maximum total balance, usually over $300,000. Plus, you can contribute up to $18,000 per year per child without triggering gift tax. If your child doesn't need the money, you can transfer it to another family member or even roll up to $35,000 to a Roth IRA, as long as the account has been open for at least 15 years. However, if you use the money for non-education expenses, you will owe taxes plus a 10% penalty on the earnings. Strategy number 2, own assets instead of just earning salary. The easiest way to play the rich people's game is to own assets. Stocks, real estate, or even small business investments can all give you tax advantages that a salary never will. Tip number 3, live in a tax-friendly state or optimize where you work. If you can, consider relocating to a state with no income tax, like Florida or Texas. You'll be amazed at how much you can save by not paying state taxes. You can also reduce your tax burden by working remotely for an out-of-state company to avoid state income taxes where you live. Strategy number 4, hold investments for over a year. If you hold your investments like stocks, real estate, and so on for more than a year, you qualify for lower long-term capital gains tax rates. So, if you're planning to sell a stock, wait until you have owned it for more than a year to save money on taxes. It's not about working harder, it's about working smarter with your money. Whether it's investing in tax-free accounts, owning assets, or using smart tax strategies, small changes today can lead to massive savings over time. Now that you know how the rich legally avoid paying taxes, I want to hear from you. What's one tax-saving strategy you're excited to try out? Drop your thoughts in the comments below, and don't forget to subscribe for more ways to keep your money working for you. If you found this video helpful, be sure to hit that like button and share it with your friends. See you in the next one.